All right, ladies and gentlemen, we are still on the calculation, right? How to calculate. Guys, listen. Mamela, Jonga, Leisre. Guys, you see, well, what we are doing now is a little bit trickish, right? You must listen very well because this is calculation. I know most of us will get scared, get worried when we see things of calculation. You must focus, right? Please, I say brief, s'il vous plaît. Right, listen. We are trying to calculate gross profit, right? Okay, before then, there is something I want to introduce to you. There is what we call variable costs, variable costs, and fixed costs, total costs, right? Total cost of a product is made up of fixed costs and variable costs. Fixed costs. Why we say fixed cost is the type of expenses that you come across in your business or in the process of doing your business, whether you are selling, buying and selling, or you are producing, or you are rendering services, the cost or expenses that remains the same, that remain constant, that doesn't change. We call it fixed cost. For example, your rent. Hello, focus. Your rent is a fixed cost. Right. For example, if you have an insurance policy, listen, if you have an insurance policy, do you know what they call that money that you pay every month to the insurance? You know the name? We call it premium. That is the right name. The premium that you pay to insurance policies, it doesn't change, it's the same. It's another good example of a fixed cost. Right. Those days we used to have a line, telephone line, telephone. You were very small that time when we used to rent. We have a line renter, then the consumption amount, the consumption, you got the usage. You got line rental separately, then the usage separately. That line rental amount is always fixed, but the usage is variable because it changes as per the phone calls that you made. Does it make sense to you? Right. Salary. Salaries is a fixed cost. Right. When you engage somebody, you are paying that person on a monthly basis at an amount agreed upon. Whether you sell, you don't sell, is the same amount, right? You're gonna pay that person. Salaries is a fixed amount. It's a fixed cost, right? Wages, younger, wages is a variable cost. Salaries, fixed cost, wages, variable cost. Why do we say wages is a variable cost? Because most often you pay wages to casuals. Casuals. If your business is doing well, right, you can engage the services of casuals. Then you pay them. When the business is low, then you can tell them to go. You engage the services of casuals as at when needed. So it's not fixed, right? So if somebody asks you perhaps in the exam to give an example of fixed costs and variable costs, right? Listen, focus. Salaries, variable cost, right? No, salary is a fixed cost, sorry to say. Rent is a fixed cost. Premium insurance, right? It's a fixed cost. Line rental is a fixed cost, right? Any expenses that you incur during the process of your business transaction that remains the same month in, month out. It's a fixed cost. Do you understand what I mean? Okay. Now let's delve into variable costs, examples of variable costs. The cost of your raw materials is a variable cost, right? Because you buy raw materials to make your product. True of us. Okay. Or if you are doing a retail business, we got different types of businesses. We got businesses that is retail. You buy, you sell, you buy, you sell, you buy, you sell, right? Then we got businesses that are manufactured, they produce on their own, then they sell. Then you got services business. Now, in a retail business, let's talk about the variable cost. That particular item that you are buying to sell, the cost of that, which we could say the cost of sales, is a variable cost, the cost of that item. Because the more your business is booming, you are selling, the more you quickly go and buy, right? Then the money that you spend now gonna be increasing. So it depends on your sales. If your sale is moving higher, going higher, then you quickly go and buy. That means you are spending more money now, right? Compared to if your sale is going down. When you sell, you buy. When you sell, you buy. You see, the cost is moving up and down, right? It could be up, it could be down, or it depends on how it is. But the bottom line is what I want to establish is you sell, you buy, you sell, you buy. For example, if your sales in January, for example, was 10,000, right? Then your cost of sales, right, it should be within it's not increasing. Let's say February, let's say January 10,000, February 10,000, your cost of sales is not going to increase. Right. Okay. Maybe I have to explain to you like this. For example, if you are selling bread, bread, sonka, right? Bread. If you are selling bread, okay. Let's say the cost price to you for bread is 7 rand. 7 rand, right? Do you understand? You buy bread 7 rand, then you're selling it at 10 rand, right? Okay. Now, let's say in January you sold 5,000 bread, 5,000. Or let me say it's too much so that you can multiply it. Let's say in January you sold 1,000 bread. How much will you use to buy the bread? What is the cost price or the cost of sale? It's gonna be 10,000, right? Times 7. That is 70,000. Right. 70,000 is what you use to buy the bread. So if your sales, Jonga, I'm trying to establish now why we say that bread, the cost of that bread is variable. So if your sales jump to 20,000, so how much will you use now to buy the bread? It's gonna be 20,000 times 7, right? Which is 140,000. Did you see now? It's going up, right? Okay, let's say in the month of March, your sales goes down to 5,000. So how much you gonna use now to buy your bread? 5,000 times 7, 35,000. You see, it's going up and down depending on your sales. That is why we say the cost of you buying the materials or the product you are selling is a variable cost. That particular product you are selling is a variable cost. The cost of buying it, it goes up and down depending on your sales. Right. If you are manufacturing, it's the same thing. Because when you were selling 10,000 bread, the cost of you acquiring the material to make the bread gonna be lower compared to the month of February when your sales production have increased. So in the month of March, If your sales comes down, what is going to happen to your cost of sales is going to come down as well. That is what we are saying. Now, when you look at this graph, right, you see the fixed cost is the same, right? That is why when you see, this is a graphical resolution, right? I don't know whether you are seeing it. This is, we call this one y-axis, right? This is the x-axis, right? So the fixed cost line is always horizontal. This is the fixed cost, right? It's always horizontal. This is the fixed cost. It's always horizontal. Do you understand what I mean? Then you see this one is the sales line, right? Then this one is the variable cost. The variable cost. Did you see the sales is higher than the variable cost and the fixed cost? Right. If you are making profit, ordinarily it's supposed to be like this. Right? Your sales supposed to be higher than the variable cost and the fixed cost. Otherwise, how are you making, how is your business doing? Right? Your business is there to make profit. It must be higher. Right? So the fixed cost plus the variable cost makes the total cost, which is not represented here. Right? By the time we're going to be doing graphical resolution, I'm going to show you, this is what I did for your peers, for your colleagues. Right? Then you're going to have something of this nature. I'm going to draw it just a little bit here. I hope you can be able to see it. You're going to have something of this nature. Can you see it? Hello? Girlie? Can you see this? You can't see it. Can you? Okay. You see, this one, let's say this is 0, right? Let's say 10, 20, 30, 40, 50, right? This one is rand in money. Let's say this one is in millions, right? Millions, big bucks, no small money, millions, for example, or thousands, right? When you do like this, means thousands, right? Now, this one is the amount. Here is the U quantity, right? You could say 5, 10, 15, 20, 25, 30, right? For the fixed cost, right, is horizontal, like this. So what it means is, whether you sell, you don't sell, this amount must be paid. Do you understand what I mean? Irrespective of the sales, you must pay your rent, no matter what, right? That is why it's being represented like this. It's horizontal, right? Irrespective of the amount. Now you have the this one. Then the variable cost. This is the variable cost. This is the fixed cost. Right? Now you have the variable cost. Right? Then your sales start from here. This is, we call this one revenue. Right? The revenue. Or your sales, as the case may be. Did you see? Right? Here we call it the break-even point. We're going to come to that. The break-even point. Right? BEP. When we get there, I'm going to tell you. The break-even point in rand and the break-even point in unit. But don't be confused. I'm going to explain this one in detail when we get to the point of break-even. So this is what we are talking about. So when you look at it, the variable cost, as we said, increase as the sales increases. It goes with the sales. Then the fixed cost remains the same. Just as I've explained. Do you understand it? Right. So if they ask you to give examples of fixed costs and variable costs. You should be able to give example. For example, labor is a variable cost. It's variable. Why is it variable? This one is mostly applicable if you are manufacturing it. For example, the labor involved in manufacturing, in making 10,000 bread is quite different from the labor involved in making 5,000 bread. You need more people now to work. Even if you don't need more people, they need to put in more hours to be able to produce more. So labor is a variable as well. If they ask you in the exam to give example, say materials, then direct labor, and what it depends on the type of business. For example, if you are in the transport business, the price for petrol, fuel, is a variable cost because the more business you have, you drive around, right, to deliver. Then the more fuel, petrol that you're gonna use. Are you all right? Long time no see. Right? Where have you been? Okay. Do you understand what I'm saying? Does it make sense to you? For example, telephone, your airtime. The more volume of your sales you need to contact people, do delivery, the more that you're gonna expend airtime. So airtime could be regarded as a variable cost. Right. The rental of your phone, what do you call it? Phonium. You know phonium? Yeah, you pay the same amount. So you can say the rental of your phone, for example, for phone that you've got to make your business, that rental is a fixed cost because you are paying the same amount. Right. Do they give you airtime along with phone? How many of you got phone? Is that phone? But you understand what I'm talking about? There is a program. No, there is a scheme. Guys, listen. There is a scheme. They call it phone. You rent phone from them. You don't know about it. You use it, but you know about it. Do they give them airtime along with it? Okay. 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 If it is like that, the rental amount itself for that phone is a fixed cost. Then your airtime for you to do your business is a variable cost. Does it make sense to you? I like that scheme. They are making money, né? Making good. That is a very good scheme. Making good money. Right. So, guys, you understand it now. Right. So, how do you calculate profit, gross profit, and then net profit? Right. For example, when you buy your stock, those stock needs to be sold. Listen, focus. Right. So you need to, for you to be able to calculate what we call gross profit. Guys, this thing is logical. You must follow it the way it is, right? That says you remove the cost of sales, how much it costs you to acquire the product if you are buying and selling, right? The cost of sales here is the amount it costs you to pay for those items if you are buying and selling. But if you are manufacturing, the cost of sale become much more broader because there are a lot of things you need to consider there now. For example, you need to buy materials, right, to make the product, like the bread making, for example. You need to buy flour, right, to make bread. You need to buy yeast. You need to buy sugar. You need to buy salt. You need whatever you need to buy. You need to calculate all those things together to make the cost of sales as well as the labor. Did you see? Because people need to be paid to make the bread. So all the direct material and the direct labor and whatever that are required to make the bread, expenses, then must be part of the cost of sales. Right? Nobody gonna bug you with these ones because for you to be able to calculate cost of sales is something that involve unless you are doing it at a higher institution level. Here, there is a career that preoccupies itself in calculating the cost of sales. We call it management accounting. We are not doing management accounting here. Nobody gonna ask you much about this, right? Just for knowledge sake. Then, when you remove all those costs, then you have gross profit. For example, like I said, if we are making bread or we are selling bread, the bread is 7 rand. The bread is 7 rand, right? You are selling 1,000, right? Then you got the selling price for the bread, which is 10 rand, right? So 10 rand times how many we say 100, right? Would that be 10,000 for the revenue that will be generated? That one will be for sales. To calculate or for you to establish the cost of sale is the number that is sold if you are not given. The number that is sold times the selling price. We got what we call selling price and the cost price. Do you know the difference between selling price and cost price? You know, all of you, you know, selling price and cost price. If you are selling something, the amount you paid for that product, right? You've gone to perhaps Macro to buy your product. The amount you pay per unit to Macro to get that product is the cost price, what it costs you to procure or to obtain or to buy the product is what we refer to as cost price. Remember, you are a business person, right? You need to put what we add something on top before you sell it, right? That's something you are adding on top. We call it markup. Markup. Yeah, you mark up. You put something on top now, right? You add something on top of that to get the selling price, right? For example, if you bought your bread 7 rand, you decided to put a markup of 3 rand, right? Then your selling price now will be 10 rand, right? Because when you sell it 10 rand, at least you're gonna make a profit. Does it make sense to you? Right. So if you see what I did there, look at this. Can you see bread? No? Let's say cost price 5 rand. I hope this my stuff is still working. This Chinese stuff, the battery goes quickly, goes down so quickly. Okay, guys, you see, cost price 5 rand, right? Selling price 8 rand. You cannot still sell it 5 rand unless the product is getting almost, unless it's a slow moving product. You want to get rid of it, you must have made your profit. Like what normally happens in most of these shops when they discount the price, right? Under normal circumstances, at a normal price, you cannot sell it the same price as your cost price, right? Then let's assume that it's 500 units. Fixed cost. I want to calculate for you now I want to demonstrate how to calculate gross profit and the net profit. Right. So now, sales. How do we calculate the sales? How, how many bread? 500. Then you multiply it by 8 rand. Do you understand why it is like this? Why the sales is being calculated like this? 500 rand times 500 units times 8 rand. Do you know why we're doing it like this? Huh? Yeah, yeah. Okay, do you understand it? Why it is like that? Is it confusing? Is it, yeah, you. Is this one confusing? 500 times 8. You sure? Okay. This is the sales now, right? Is you've gone to buy bread. Then you come to your shop, your tax shop, you put there, you bought 500, right? When customer comes to you, how much is your bread? 8 rand, take, right? At the end of the day, you sold the 500. Now you must check your money. It must be 4,000. Does it make sense to you? Right. Let's assume you bought the bread on credit. Somebody came to supply you the bread, right? Let's assume that you have the shop. Me, I'm the one that is selling the bread to you for credit. I'm the supplier. Let me call it that way, supplier, right? I comes to you, I've given you 500 bread. Then you ask me, how much is it? I say 5 rand. You say, okay, give me 500. Then I've given you 500. You own the shop that is selling. I will tell you at the end of the week, on Saturday, I'm coming to collect my money. Right. Then you're going to be selling. Now, at the end of the week, you sold the 4,000 rand. On Saturday, then you will be expecting me to come. When I come to you, I say, where's my bread? Where's my money? I mean, how many bread you going to ask? I'll say, I gave you 500 bread, right? And I'm selling it at 5 rand. So I'm expecting you to pay me 2,500. Does it make sense to you? Do you know how I got 2,500? Do you know? You sure? Who doesn't know? 500. That was the bread. 5 rand. Is it clear? Who doesn't know? Who doesn't understand? Guys, tell me if you don't know because this thing is very tricky. You know why it is 2,500? You sure? Okay. Now, the supplier is coming to take his money. You must pay, right? For the business to continue. From that your 4,000, you must pay me my 2,500. Right? Then when you remove it, what is gonna left over is what we call gross profit. Does it make sense to you? We call that one gross profit. We call it gross profit because there are still some expenses that you need to pay. You cannot say, hey, this is my profit now, let me go and enjoy it. I'm going to waterfront to have a lekker time with my sweetheart. No, that money doesn't belong to you yet. You still have to pay your fixed cost, right? Here, you are given that the fixed cost is 200 rand, right? Then you must remove fixed cost. When you remove fixed cost, I hope the table is not blocking you. Are you seeing it? Are you seeing it clearly? Then what is left over is net profit, right? Net profit. But if you are a company that is registered with VAT, right? This money doesn't belong to you as well. Here we're gonna call it net profit before tax. But I think here now they are not talking about tax here, right? You see, here you still have to pay the government tax. Let's say 30% of this. 30% of this one is about 900 rand. Yeah, 900 rand. Is it 900? Yeah. Then when you remove that, you see, not 900. 30% is about 3,900. 390 rand. Now you must have to pay government that. You see? So whatever that is left becomes yours. Is it clear? Is it clear? So if they in the exam they give you a question like this, can you be able to work it out? Can you? Okay. Guys, look at how to calculate the markup percentage. Are you here now? Okay. So guys, tomorrow we're gonna continue from here, right? You must practice this thing at home. Eh?